Hey everyone, and thanks for jumping back into the Macroverse. Today, I'm going to provide my thoughts on the most recent Monetary Policy Report to the Congress by Jerome Powell. Today, he spoke in front of the U.S. Senate Committee on Banking, Housing, and Urban Affairs, and then tomorrow he'll be speaking in front of the U.S. House Financial Services Committee. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Again, we do have several different tiers available, including a free one where we put out a weekly newsletter. Make sure you sign up. Links in the description below. Let's go ahead and jump in. Now, I know the discussions about macro concepts and whatnot are not necessarily the most riveting, though I do think they're important for sort of informing us of good ways to potentially navigate financial markets. So I do think a lot of important things were said today by Jerome Powell. Sort of concessions were made in terms of some of the recent data that we've seen come in. And one of the things that has been hanging over, expectations at the next FOMC are whether Powell would look towards the most recent revisions in inflation data and the hot jobs report as reason to be more hawkish than perhaps otherwise expected. So we want to talk about a little bit about that because he did comment on that in a potentially somewhat indirect way. One of the things that Powell has said today, in fact, and he said this in his opening testimony, was that they're essentially looking at a reversal of what they thought they were seeing. So they thought at the last FOMC that they were seeing a sustained path of disinflation, where inflation was continuing to slowly come down. Now, there's a difference between disinflation and deflation. Remember, disinflation does not mean prices are not going up. Prices are still going up. It just means they're not going up as quickly as before. Deflation is where prices actually go down. So at the last FOMC, there was at least some evidence of disinflation. And this is something that we've spoken about many times, is that, you can see these elements of disinflation in various sectors, but in one of the sectors that Powell cares the most about, and he even mentioned it in his speech today, or in his comments today, is he says there's little sign of disinflation thus far in the category of core services ex housing. And he's pointed to this many times, and we can see that sector has remained a lot stickier than a lot of the other sectors, and even goes on to say that this is a category that accounts for more than half of core consumer expenditures. So he is very aware of sort of the risk here that inflation is putting on just regular people throughout the country. And he even sort of chimed back at some comments, sort of calling him out on trying to raise the unemployment rate. And his response was, well, what do? Do we just not do our job and allow inflation to just remain at 5 to 6% for years to come? Or do we do our job and try to get inflation back down? And I think this is a tricky thing because, to see people lose their jobs is not something that, people generally want to see. But we also don't really want to see inflation running at 5 to 6% for years to come, because this is also going to have extremely negative consequences for, not just financial markets, but just for people that are trying to live their lives. Go to a grocery store today, and it's hard to get out of there without spending maybe, twice as what you might have spent just a few years ago. So high inflation is certainly impacting the overall economy. And I know that Powell is very much aware of this. He did say that the social costs of failure are very, very high in terms of dealing with, in terms of inflation. He says, so if inflation were to continue at some point, that would become the psychology. Businesses would come to expect high inflation, and that would make it even more self-perpetuating. That would mean an up and down economy. It would mean something that looks more like we've seen during periods of high inflation. Capital allocation is difficult in a world like that. What we want to do is restore price stability firmly, back up 2% so that we can have a strong labor market for a sustained period like we had before. Now, there's been a lot of people that have sort of discussed that that Powell and the Federal Reserve are going to shift their goal of 2%. And despite this view that I've seen expressed many, many times over the last year and a half, this has just simply not been the case. They've sort of doubled down on the goal is 2%, and to see a sustained path back down to 2%. Now, there's been a recent repricing in expectations for the Fed funds rate, and There's a lot of different reasons for that. Of course, Powell was fairly hawkish today, but one of the things that he said that I think is worthwhile to really hone in on here is he says, and he was referencing his opening testimony. He says, as I pointed out in my testimony, we are looking at a reversal of what we thought we were seeing. To some extent, a partial reversal. Well, what is he talking about? And we talked about this before, right? There's this left tail risk for financial markets of a temporary reacceleration of inflation, right? The two main risks, I think, are the reacceleration of inflation and the deterioration of the U.S. economy. That doesn't mean they're the only two risks, right? There's also the geopolitical risk as well and other risks. But the two main ones that we were sort of thinking about over the last several months were the reacceleration of inflation and eventually the deterioration of the overall economy. Of course, the geopolitical risk is going to always be there, but that's always there, right? Whether, no matter what's really going on. So that's all, something to consider, of course. But so he says this, right? That they're seeing a reversal of what they thought they were seeing, and actually take a closer look at this. If you were to go look at let's go look at the PCE price index. I want to take a look at this. If you were to look at, say, like the monthly change, you can see that it hasn't really gone in the direction that they were hoping it was going to go, right? If you were to go take a look at the PCE price index inflation year over year and look at the monthly change on this, you can see it's gone back above zero, meaning there's at least some element of reacceleration there. And then the question is well, is this temporary or is it going to be sustained? Take a look at core PCE price index inflation and look at the monthly change on this. Again, it was negative. Now it has gone back to being positive, meaning there's some element of reacceleration. And the question is it going to be a sustained level of reacceleration of inflation, or is it just going to be, for lack of a better word, transitory? Now, my guess is that while there is some element here of the reacceleration of inflation, which is something we've talked about for months on end, I do think there would be certainly an element of it being transitory. And one of the reasons for that is because I think the Fed will likely do what needs to be done to continue to put pressure on the jobs market and in general in the U.S. economy. So when you look at this at least temporary reacceleration of inflation, you couple that with what Powell is saying, that they are looking at a reversal of what they thought they were seeing. How can you not at least assume that they're now considering a 50 basis point rate hike in March, right? And so let's not take my word for it, right? Or let's not go based on what Ben thinks, but what does the market think? Does the market think that there's a chance the Fed is going to go with a 50 basis point rate hike? And the answer is yes. As of right now, as of March 7th anyways, maybe you're watching this video on March 8th, but as of March 7th, the likelihood for a 50 basis point rate hike in March has now gone to 67.5%. So just a few days ago, we were looking at this as 2/3 and 1/3 for a 25 basis point rate hike being 2/3 chance. Now it's flipped. Now the odds of a 25 basis point rate hike, according to the market, is only 32.5%, or about a 1/3 chance. So this is a complete repricing of expectations at the March meeting. If you go out to May, if we were to see a 50 basis point rate hike in March, which right now is the expectation by the market, a lot's going to happen between now and then. We do have another jobs report coming out. We have another inflation report coming out. This is subject to change, right? I know you're on the edge of your seat, but if there's a 50 basis point rate hike in March to get us to 5.25, and you go look at what happens in May, there's actually a chance there's another 50 basis point rate hike then to get us to 5.75. And then it's like, well, if after 2 or 3 meetings from now, we're at 5.75, let's say we're at 5.75 by June, potentially, you're already knocking on the door of 6%, which again, this was not even seen as a strong likelihood not that long ago, right? And this is why last year, I was very hawkish myself on the Fed funds, on where the Fed was going, because it just seems like inflation is going to be stickier than a lot of people think it's going to be. And the idea that we can't go above certain levels just because it hasn't happened in the last 10 years, well, sort of the responses will wake up, right? Inflation hasn't been this high in 40 years. So we shouldn't look at what has happened in the last 10 years to understand where the Fed should go, right? We should look at it in the context of where inflation was previously at levels similar to this. And during those times, so the blue line is inflation year over year, the orange line is the effective interest rate. During those times, interest rates went a lot higher than maybe you would have thought going into this based on the last decade of monetary policy. So I think it's worthwhile to consider when you're navigating the macroverse, not to just look at what happened over the last 10 years, but to go find conditions that are at least somewhat similar. Again, we're not saying that the 70s are the same as now. We're not saying that the 40s are the same as now, but the similarities in terms of being high inflation, we saw the reaction function by the Federal Reserve back then, and to assume it should be much different today is, could work out not so well. So when you look at interest rates compared to inflation in the past, you can see that interest rates did go a lot higher than sort of the baseline or where they were previously. So this, of course, this is the main risk that we've talked about is sort of this reacceleration of inflation and what will the Federal Reserve do. Now, as I mentioned, there's a lot more data to come out between now and the next FOMC, okay? A lot more. And so this can change quickly. Could go even more in the 50 basis point direction, right? Could flip back to 25 basis points. The truth is, I don't know, but what we're talking about here is what is the risk, right? What is the risk on the market? And the risk is that the market is sort of thinking that inflation is just going to go back down in a linear fashion, back to 2%, but there's not really a lot of evidence that this is the case. There's actually a couple of interesting quotes, and this is one of the senators said this to Powell. If history is right, unless you get some help, and he's referring to getting some help from, say, like other people in government that can maybe change fiscal spending, that sort of stuff. So he says, if history is right, unless you get some help, in order to get inflation down from 6.4% to 4.4%, the unemployment rate is going to have to rise to 7% based on history. This is what he said. And then Powell said, that is what the record would say. And so this is one of the things we've spoken about before, is that how do you get inflation down in a sustained way without having some effect on the labor market? Now, one of the biggest debates I think that economists have had over the last year and a half is, are we in a recession or not? And one of the main things that I think people point to when they argue that we're in a recession is they would look at the quarterly change in real GDP back in early 2022 and say, hey, we got 2 consecutive quarters of negative GDP, therefore we're in a recession. Be that as it may, even though we had 2 consecutive quarters of negative GDP, we've gone back up, right? And in fact, real GDP is putting in new highs. So you can't even point to 2 consecutive quarters of negative GDP anymore as a reason that we're in a recession, right? You can't look at that anymore. But another way to look at this is to just simply go look at the unemployment rate. And you overlay that with recessions, these gray shaded regions. And again, when the unemployment rate starts to go up, that's where you see your recession. Right? That's where you normally see it. Furthermore, during periods of high inflation, let's say you look at headline inflation year over year, it normally takes a recession to get inflation to actually come back down in a sustained way. If you zoom in over here, right, you can see we had a recession here at the top. We also started to come back down, and then inflation started to reaccelerate, and then we got a recession, and then that brought it down in a sustained way, right? It was coming down, and then that happened. Now you might say, well, in a lot of these cases, you'll see a recession near the peak of inflation, right? Near the peak here. And again, near the peak, right at the peak. A lot of these are right at the peak or coming out of the peak. So why this time are we not seeing that? Again, part of the reason for that, I think, is because the Fed is so far behind the curve on where they should be. Again, take a closer look at this indicator, the U.S. inflation versus interest rates. Normally, interest rates are trying to stay above inflation, right? Look at the orange line compared to the blue line. But now look at where we are. So you could argue that the reason that we haven't really seen a recession yet is because monetary policy has just been too loose for too long. And had the Fed tracked the effective interest rate with inflation or tried to keep pace with it, the effects of that monetary policy when it should have been implemented back in, say, early 2021 would be felt today. And then those effects from those interest rate hikes back in 2021 would of course be felt, by this point in 2023, and you likely would be looking at a recession. But the problem is that it can take like 3 to 4 quarters for the effects of interest rate hikes to fully be felt. Now, that's not entirely true. I mean, if you look at mortgage rates, right, we know that mortgage rates have been going up. It's not like you had to wait a year to see that. But in terms of how it affects small businesses, in terms of how it affects the economy in general, there are a lot of elements to say, look, if people got loans at lower rates, right, it doesn't mean that it's, that just because you raise rates doesn't mean it's going to necessarily affect their bottom line, not until, they have to get out new loans. Right? Think about one of the reasons the housing market hasn't come down quickly. We see low demand. We also have low supply. Why do you think we have low supply? So many people locked in mortgages, at 2 to 3%, that they would be somewhat remiss to sell their home and have to get a higher mortgage rate. So right now, yes, it's true that there's very little demand because 30-year fixed mortgage rates are at 7% now and could easily go higher, but there's also not a lot of supply either. And again, it's because people don't really want to get a new mortgage rate because they know that they probably can't afford nearly the same type of house as they could when they locked in their mortgage rate. Now, you could say, well, prices have come down. Yeah, prices have come down some, but not nearly enough to offset how much more they have to pay in interest because of how much higher how much higher mortgage rates are now. So I think there's some element of this argument around, are we in a recession, are we not? Normally, the Fed wouldn't be so far behind the curve, right? Normally, we wouldn't be in this predicament, right? They would have already raised interest rates a year earlier. But because they waited so long, inflation has persisted. We've seen at least a temporary reacceleration of inflation. And what ultimately is happening? You're seeing the markets start to reprice what the terminal rate is. Now, again, look, and as I make this video, the odds of a 50 basis point rate hike continue to go up. Earlier, I saw them at 30% earlier, maybe last night. And then, then you saw them at 40% and then 50, 60. Now it's at 73.5%. Just since I've been making this video, it switched from 1/3 to 2/3 to now 1/4, 3/4. Now, let's go take a look at May, right? Still likely markets are thinking 25 basis points to get you to 5.5 after a 50 basis point rate hike in March. But take a look at the probabilities over here. This is what I think is the most interesting aspect of it. The terminal rate has been completely repriced, right? It wasn't that long ago when the market thought the terminal rate was 4 3/4, right? Think about that. Roll back the clock just a couple of months. The market thought that we were basically near the terminal rate and it was going to be over with soon. Now, look at this. The market is suggesting 5 3/4 will be achieved by June, which is only 3 meetings from now. 5 3/4 by June. And then to hold there for the remainder of the year, followed by rate cuts in 2024, but no rate cuts in 2023. Now, there's some elements of, you have to remember that market expectations change all the time. And to some degree, expectations of certain things can lead to then ultimately things changing because the markets are sort of pricing in that change. I know it's sort of mental gymnastics to some degree, but if markets are finally starting to believe the Fed, then and you see risk assets respond in kind and become more devalued, then that could lead to the quicker deterioration of the U.S. economy than maybe would have otherwise been seen had the market continued to not believe the Fed. And so, of course, you could see this shift to seeing cuts in 2023 if the Fed were to go on and break something. But remember, one of the things about a recession is that while it is difficult that people, that people lose their jobs, the other thing that's difficult is living with high inflation for years and years and years. And in fact, one of the I believe it was Warren said, I mean, she said, okay, so and putting 2 million people out of work is just part of the cost, and they just have to bear it. And then Powell retorted, would working people be better off if we just walk away from our jobs and inflation stays at 5 to 6%? So it's like, it's not an easy job. The Fed is tasked with two things, right? They want to keep unemployment low. They also want to keep the inflation low. But how do you keep inflation low if you have a historically tight labor market and upward price or upper wage inflation? Now, he did say that wage inflation was moderating, but this is a risk that you have to weigh. And be that as it may, I mean, all the interest rate hikes that have occurred so far occurred while the unemployment rate has continued to go down. So far, it has not even really had, I think, the desired effect of softening labor market conditions. And now, it doesn't mean it won't. Remember, it's a key thing you have to remember. You can't just look at this and say that, we will never go into a recession because the unemployment rate is a secular low. I'm of the opinion that we're not in a recession. I mean, I've said this for a year and a half now. But the thing is the unemployment rate can often hit the lowest levels of that business cycle just before the recession gets underway. And you might look around and say, well, restaurants aren't feeling the effects. I mean, one of the issues, you go to a restaurant and it seems like they're understaffed, right? It seems like they're understaffed, which is true. I mean, there's a lot of truth to that. But you also have to remember as well that by the time that the U.S. economy feels the effects of all these interest rate hikes, there's a good chance that risk assets are already back off to the races, and bottomed out long before and are already trending higher. And I guess some people might make the case that that's already occurred. Where I have trouble necessarily agreeing with that sentiment is if you look at things like the inversion of the yield curve. Okay, I mean, this is a pretty one that's old as time to some degree. But I mean, normally this sort of precedes a recession. Now, again, when you have the inversion of the yield curve, we're not normally in a recession, right? Look at the inversion of the 2-year, or sorry, the 10-year and the 3-month, right? When it's inverted like we are right now, we're not normally in one. But it's when it becomes uninverted. The same thing with the 2-year and the 10-year. It's not when it inverts that you normally get a recession. It's when it uninverts. And why does it uninvert? Because the Fed is pivoting. And why do they pivot? Because they broke something. And why did they break something? Because they were too hawkish. And why were they too hawkish? Probably because inflation was too high. And the cycle goes on and on. And so, Powell came out today and was pretty hawkish about what he had to say. And I mean, one of the quotes that I said earlier to some degree, but I'll go into a little bit more detail now. He says, at the end of last year, we saw a couple of very promising, modest inflationary readings in November and December. But earlier this year, some of that improvement was revised away. What does he mean by that? Well, after they get the initial data, they'll often revise it, a few weeks later, based on more accurate readings. And as he's right, what he said is true. I mean, a lot of the things that looked good back even in November and December, forget about the reacceleration, right? Forget about that. Even if you don't have the reacceleration, there's elements of some of the optimistic things that occurred back in November and December are no longer so optimistic because they were revised back up to the upside. So he actually noted that. And he said, but earlier this year, some of the improvement was revised away. In addition, we got a very strong reading on inflation in January, also very strong jobs reading, also very strong retail sales. As I pointed out in my testimony, we are looking at a reversal of what we thought we were seeing, to some extent, a partial reversal. Now, there were some things he threw in there, I think, to make the blow not feel so hard. He said, he did say that the Federal Reserve is accounting for the lags of the effects of interest rate hikes on future decisions for rate hikes. So I don't think he's completely oblivious to the idea that interest rate hikes have significant lag times in terms of how long it takes for them to be felt throughout the economy. But the counterpoint to that is if you were to go look at the National Financial Conditions Index, which is sort of like a measure of loose or how loose or tight monetary financial conditions are in the U.S. economy, you can see that while financial conditions were becoming tighter throughout a lot of 2022, you can see they sort of peaked here in October, and then they've been getting looser ever since. Now, this poses a challenge because if financial conditions are getting looser, that means that you can see, what we're potentially seeing here, which is the reacceleration of inflation, which again is the left tail risk that we talked about for financial assets. Now, if you look at this closely, though, it's starting to curl up here a little bit. So let's take a closer look. Look at the weekly change. You look at the weekly change, financial conditions were getting extremely loose not too long ago. And we saw rallies in a lot of financial markets, not only in equities, but also in crypto. But now that change is quickly coming back in. And if this path continues, we're going to see, we're likely going to see tighter monetary conditions in the next few months. And so I would speculate, dubiously of course, is that the Fed is likely going to want to bring this back in and curtail some of these loosening monetary conditions that we've seen over the last few weeks to make sure that inflation and inflation expectations do not become entrenched. All right. One of the things that I thought was interesting is, one of the senators said, if history is right, unless you get some help, and maybe I mentioned this earlier, but I just want to say it again because I think it's important, because there's also another end of the quote too. If history is right, unless you get some help in order to get inflation down from 6.4% to 4.4%, the unemployment rate is going to have to rise to 7% based on history. And Powell said that is what the record would say. So he acknowledges that it's a difficult battle to bring inflation back in line with the 2% objective without seeing some softening of labor market conditions. They also went on to say that, something to the tune of, bringing it down to even the 2% or around that level could see the unemployment rate go up to 10%. Now, I do struggle to see the unemployment rate going just that high. I'm not saying it can't happen, but I do think that there is some element of a labor shortage right now. So I think the economy still has a lot to absorb in terms of the effects that all these interest rate hikes are going to have and getting people back into the workforce. So I don't really foresee the unemployment rate going back to 10%. But this is, Powell did say that is what the record would say in terms of what does it actually take to get inflation from 6% or 6.4% to 4.4%. And he certainly acknowledged that. Okay. He did say that over time we can achieve 2% inflation, and we will, sort of going against these expectations that people say that they're going to change their objective to 3 or 4%, and so on and so forth. And he did say his normal what he normally says, right? He says the historic record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. The ultimate level of interest rates is likely to be higher than previously anticipated. And I think that this is important because I think that, when you think about where monetary policy is and the effects that it's going to have on inflation, if you get a period like what we had back in the 1970s, if you get a period like that, you can see the market go sideways for a long time and the economy just sort of stagnate for a decade. And I think Powell is doing is as good of a job as he can at trying to avoid this scenario. Who wants to live in this scenario? Like, I would prefer to live in the scenario where, inflation just comes back down and then we can have another phase of economic expansion. Because look what happens. While it's difficult, look what happened in the 80s. Living through this, right? You had 2 recessions to bring this back down. And it sucked, right? And the market went down. But look what happened after it. You had a crazy era of economic expansion. And why were you able to see that economic expansion? Because we had low inflation. Well, it's one of the reasons, right? It's not the only reason. But one reason that you were able to see this level of expansion was because you actually had a low level of inflation that could support said expansion without going back into high inflation. And so I think that that's ultimately what Powell's trying to achieve is to get inflation and inflation expectations back in line so that we can get back to a period of economic prosperity. I think he really looks at the historic record, as he's mentioned many times, and wants to avoid some of the mistakes that previous people have made in the Federal Reserve, and that's namely loosening monetary policy too soon that then led to the not transitory reacceleration of inflation, but something that lasted for several more years. Okay, so that is, I think what Powell's trying to avoid. Now, when I say that I think this acceleration of inflation that we're kind of seeing right now, I do think it's transitory, not in the sense of transitory in 2 to 3 years. I think it's probably transitory over the next few months, right? So by the latter half of this year, I do think we're going to see inflation coming back down in a more sustained way. probably because the Federal Reserve they're going to raise interest rates to the point to really bring inflation back down. Again, we know that recessions can bring inflation back down very, very quickly, and ultimately there certainly is a risk that's going to happen. Okay, now how have markets responded? The U.S. dollar currency index is breaking to the upside. This is one of the things we've talked about many times, is that there's certainly a risk here that you'll see the dollar break back up to the upside. If you go back and look at weekly data on the U.S. dollar currency index, and we take this back to the 1980s, you will see a very similar type of move, in fact, where we went up to around that 114, 115 level, followed by a retracement down to the low 100s or so. We actually just went a bit lower this time, and then followed by basically the dollar taking off again. Now, I'm not suggesting that the dollar is going to take off again like this, and even if it did, it's not necessarily bad for risk assets over the long haul. If you were to overlay the S&P over this price, or over the dollar here, you can see that at least temporarily the dollar going back to the upside led to the deterioration of the stock market. But once the dollar broke back out and continued higher, the stock market just went off to the races for quite a long period of time. And why did the stock market go up? One of the reasons, because inflation was back down, right? We actually accomplished their objective. It got inflation back down so we could get to another period of economic expansion. So I think right now, when you're looking at the U.S. dollar currency index, it's at 105.5 or so. Certainly is here a chance that it's going to, there is sort of this chance here that it just continues back up to the upside. One thing to consider as well, another similarity, is that this actually took place over a very similar time period. About 4 months or so, about 16 weeks from this move here to the bottom. And then this move here to this bottom also took about 16 weeks or so before you started to see this move back up in the U.S. dollar currency index. So that is something that I think you still have to keep in mind as well. And then of course there's crypto, which you guys, let me actually go to the S&P 500. The S&P 500 is back below 4,000 right now, but I wanted to take a close look here at bear markets. So if you look at bear markets for the S&P 500, you look at the 2022 to 2023 bear market. Admittedly, we don't know if it's the 2023 bear market or the continuation yet of the 2022 bear market until we put a new low. But if you look at the range of historical bear markets, you can see we're kind of at the extreme of how high a bear market could go as a function of time in equities before you actually saw the S&P finally start to roll back over. Okay, so this sort of shows you the extremes in volatility of bear markets for the S&P, and so I think that's another risk that continues to remain. Is, look, yeah, we've had a great rally, but we also had pretty cool rallies in prior bear markets. It didn't necessarily mean a thing. And then, of course, finally, I suppose we should at least mention Bitcoin. Bitcoin right now is at around 22.2K. And you guys know my thoughts on it. We've talked about this a lot in terms of like what is a worst case scenario, and that's sort of if it follows the NASDAQ back in the dot-com crash, right? So like if it does follow the NASDAQ in the dot-com crash, the blueprint is there. it could deviate at any time. So I'm not asking you to take it to the bank, of course, but I would say don't just necessarily discount the similarities just because you don't like them. You still have the 77% drop from the high, right? Like if you measure this, you still have the 77% drop from the high. You still have the 60% rally into the 50-week SMA by Bitcoin, and then also the NASDAQ coming out of the dot-com crash, right? Like that 77% drawdown followed by a 60% rally to the 50-week, sort of a double top. Look at the RSI, the weekly RSI, right? Double top here on the NASDAQ. And then the RSI more or less double bottomed, okay? Which could help us mark, potentially great accumulation phases in crypto. But then also, you can see that Bitcoin did actually something very, very similar, right? In its weekly RSI. And when we made a video on this, dedicated video on the worst case scenario, the weekly RSI on Bitcoin was actually above this level. But we said in that video, look, if this comes back down by the end of the week, this too could simply look like a double top, just like the NASDAQ did. And if it does, then that means that the market could see, continued weakness. So I do think there's There's reasons to continue to be cautious, especially given this left tail risk of the reacceleration of inflation, potentially sustaining for a while, the repricing of the terminal rate, and of course, the inversion of the yield curve, which normally, historically, would suggest that the only way out is via a recession. Now, right now, I don't think we're in a recession right now, but the risk still remains that by the end of this, we certainly could see one. And if your counterpoint is that the unemployment rate is low, and if your counterpoint is that the job market is relatively tight, these are actually things that normally occur before a recession, right? So, I mean, yes, they're a good indicator that you're not in one. They're not a good indicator that one's not coming. And that's why I think what we need to be aware of. And you might say, well, why do we need to worry about that? Remember, markets are very much forward-looking, right? So by the time you see it in the economy, like by the time you go to a restaurant and it's no longer packed with customers, or there's no longer a labor shortage, right? But like by the time you see all that and can say, now it looks like we're in a recession, the market probably is already 3, 4, 5 months ahead of you and saying, congratulations on declaring the recession. Once it was obvious to everyone. So, again, I'm in the camp that we're not in one. Right now I'm still in the camp that we're not in a recession, but I'm also in the camp that the Federal Reserve is going to continue to remain hawkish until they see inflation come down in a sustained way, and there is a very high risk of them pushing us into a recession before this is all said and done. So hopefully this was informative in terms of understanding what was said today by Powell, the effects that it's having on markets. He's going to actually talk again tomorrow. I don't know if I'm going to provide the same comprehensive update because I imagine it's going to be more of the same. But again, if you do like the content, make sure you subscribe to the channel, give the video a thumbs up. Check out Into the Cryptoverse Premium at intothecryptoverse.com, and I'll see you guys next time. Bye.